I dare you to fix me. I'm crossing the line again, falling.
A contract of insurance is an agreement whereby one undertakes for a consideration to indemnify another against loss, damage, or liability arising from an unknown or contingent event. Thus, a contract of insurance is 1. A contract of indemnity, wherein one undertakes for a consideration, 3. To indemnify another against loss, damage, or liability arising from an unknown or contingent event. Contingent event is an event that is not certain to take place. Unknown event is an event which is certain to happen, but the time of its happening is not known. The general rule is a past event cannot be a designated event in an insurance contract. Exception: it may be a designated event only in cases where it has happened already, but the parties do not know about it. Example: prior loss of a ship at sea, applicable only to marine insurance. The unknown event may be past or future. Even if the proximate cause of the loss is a fortuitous event, the insurer may still be liable if it is the event or peril insured against. Form: there is no particular form required for a contract of insurance. The insurance code has no provision requiring a particular form for the validity of an insurance contract. In our jurisdiction, the Supreme Court has not made a categorical ruling against the validity of an oral contract of insurance. An insurance policy is different from the contract of insurance. The policy is the formal written instrument evidencing the contract of insurance entered into between the insured and the insurer. Doing or transacting insurance business. The term doing an insurance business or transacting an insurance business includes 1. Making or proposing to make as insurer any insurance contract. 2. Making or proposing to make as surety any contract of suretyship as a vocation and not as merely incidental to any other legitimate business or activity of the surety. 3. Doing any kind of business including a reinsurance business is specifically recognized as constituting the doing of an insurance business within the meaning of the insurance code. Number 4, doing or proposing to do any business in substance equivalent to any of the foregoing in a manner designated to evade the provision of the insurance code. General rule: an insurance business consists in undertaking for a consideration to indemnify another against loss, damage, or liability arising from an unknown or contingent event. Exception: those not formally designated as insurance business but are deemed doing or transacting an insurance business as listed in Section 2, letter B. The principal object and purpose test determines whether the assumption of risk and indemnification of loss are the principal object and purpose of the organization or whether they are merely incidental to its business. From such determination, it concludes that if these are the principal objectives, the business is that of insurance. But if they are merely incidental and service is the principal purpose, then the business is not insurance. Number 3, governing law. General rule: the insurance code primarily governs insurance contracts. Exception: when there is a special law which specifically governs, example, insurance contract under RA 1161 or the Social Security Act, in which case the insurance code governs subsidiarily. Matters not expressly provided for in the insurance code and special laws are regulated by the Civil Code. Other special laws: National Health Insurance Act of 2013. Number 2, the Revised Government Service Insurance Act of 1997. 3, the Social Security Act. D or 4, the Property Insurance Law. And number 5, the Philippine Deposit Insurance Act of 1963. Parties to an insurance contract. We have two parties to a contract of insurance: the insurer or the party who assumes or accepts the risk of loss and undertakes for consideration to indemnify the insured or to pay a certain lump sum on the happening of the event or peril insured against. May be any person, partnership, association, or corporation, and the insured or the person in whose favor the contract is operative and whose loss is the occasion for the payment of the insurance proceeds by the insurance or by the insurer. It may be a person except a public enemy. There is no definition of what a public enemy is, but a definition that is generally accepted and in keeping with the nature of an insurance contract is one where a person possesses the nationality of a state which another is at war. Elements of an insurance contract. We use C2R2L or IM. Cost, event or peril insured against. C. Consideration, premium payments paid by the insured. We have R. Risk of loss or damage being insured or assured by the insurer. And the second R is risk distributing scheme, distribution and transfer by the insurer of risk of loss, damage or liability among persons having similar risks. I. Insurable interest. The insured possesses an interest of some kind which the event insured against may cause loss or damage. A meeting of minds of the parties upon all the foregoing essentials. The cost. Cost refers to an event or peril insured against. Consideration is an insurance premium. It is the agreed price for assuming and carrying the risk. It is the consideration paid to the insurer for undertaking to indemnify the insured against a designated peril. It is based on probability of loss and extent of liability. What is the difference of premium and assessment? Premium is a sum levied and paid to meet anticipated loss. Assessments are collected to meet actual loss. Assessment is a sum specifically levied by mutual insurance companies or associations upon a fixed and definite plan to pay losses and expenses. Risk of loss or damage. Peril is the contingent or unknown event which may cause a loss. Its existence creates a risk and its occurrence results in loss. The event of peril insured against must such that its happening will indemnify or cause loss to a person or create liability against him. Risk distributing scheme. Insurance contracts serve to distribute the risk of economic loss, damage, or liability among as many as possible or those who are subject to the same kind of risk. A scheme. The payment of premiums by all will inure to a general fund, out of which payment will be made for anyone who has suffered an economic loss. Hence, each member contributes to a small degree toward compensation for losses suffered by any member of the group. Insurable interest. Insurable interest is the interest which the law requires the owner of an insurance policy to have in the person or thing insured. In terms of the event insured against, it is the relation between the insurer and the risk insured, such that the occurrence of the risk will cause substantial loss or harm of some kind to the insured. Under the code, the following are void: stipulation in a policy for the payment of loss whether the person insured has or has not any interest in the property insured. Stipulation that the policy shall be received as proof of such interest. Policy executed by way of gaming or wagering. Note, insurance interest is not required in industrial life insurance. Meeting of the minds. The two parties to a contract of insurance whose minds need to meet regarding the essential elements are insurer, or the party who assumes or accepts the risk of loss and undertakes to pay a certain lump sum on the happening of the event or peril insured against, and insurer, or the person in whose favor the contract is operative and whose loss is the occasion for the payment of the insurance proceeds by the insurer. The insured is not always the person whom the proceeds are paid. Such person is the beneficiary. Characteristic and nature of an insurance contract. An insurance contract is CAVE CCPU, or consensual, aleatory, voluntary, executory, and unilateral, but synallagmatic, conditional, contract of adhesion, personal contract, uberrime fides contract, example, a contract of the highest degree of good faith. So what is consensual? The general rule is an insurance contract is perfected by the meeting of the minds of the parties. There must be concurrence of offer and acceptance. The insurance policy merely evidences the terms and conditions thereof. Exception: it is stipulated that the policy is essential to the existence of the contract. Aleatory means because it depends upon some contingent event. The obligation of the insurer to pay depends on the happening of an event which is uncertain, or though certain, it is to occur at an indeterminate time. Being an aleatory contract does not necessarily mean that it is a contract of chance, because in a contract of insurance, the parties seek to distribute possible loss by reason of mischance, unlike a wagering contract. General rule under voluntary is that contracts of insurance are not compulsory and the parties are free to incorporate such terms and conditions they may deem convenient, provided they are not contrary to law, morals, good customs, public order, or public policy. Exceptions: insurance contracts, particularly liability insurance, may be required by law in certain instances. 1. For motor vehicles, it's compulsory motor vehicle liability insurance under Section 386 to 402. For employees, compulsory coverage in state insurance funds, that is laid out in Articles 168 to 184 of the Labor Code. Number 3, as a condition to granting a license to conduct business or calling affecting the public safety or wellness or welfare. Social insurance for members of the Government Service Insurance System or GSIS, and for the employees of the private sector covered by the Social Security System. Executory and unilateral but synallagmatic. Once the insured pays the premium, the contract already takes effect. After the payment of premiums, the insurance imposes a unilateral obligation on the insurer, who promises to indemnify in case of loss. It is also synallagmatic and reciprocal, such that even if the contingent event or designated peril does not occur, the insurer has still provided protection against the risk of the period covered by the insurance contract. It is also conditional because the insurer incurs liability only upon the happening of the event insured against. However, many other conditions are usually required, that is, payments of premium or performance of other act, as precedent to the right of the insured to claim benefit under the insurance. Now, contract of adhesion. Insurance contracts are already presented to the insured in its printed form or a take it or leave it basis. The insured merely has to agree to its terms. Such contracts of adhesion are valid. General rule: where the terms of the contract are clear and leave no doubt upon the intention of the contracting parties, the literal meaning of its stipulation shall control. Exception: where the terms of the insurance contract are ambiguous and susceptible to various interpretations, the issue is to be resolved against the insurer, being the party that prepared the contract. Thus, ambiguity shall be interpreted liberally in favor of the insured and strictly against the insurer who prepared the same. Personal contract. The contract of insurance is basically between the insurer and the insured. The insured cannot assign before the happening of the loss his rights under a property policy to others without the consent of the insurer. Next is uberrimi fide contracts. Uberrimi fide means of the utmost or perfect good faith contracts of insurance. Each party is required to 1. Deal with each other in utmost good faith. Number 2. Disclose conditions affecting the risk of which he is aware. 3. Disclose any material fact which the applicant knows and those which he ought to know. Violation of this duty gives the aggrieved party the right to rescind the contract. Where the aggrieved party is the insured, the bad faith of the insurer will preclude it from denying liability on the policy based on breach of warranty. For specific kinds of insurance contracts, for non-life insurance contract of indemnity, the insured who has insurable interest over the property is only entitled to recover the amount of actual loss sustained. The burden is upon him to establish the amount of such loss. Property insurance is personal in the sense that it is the damage to the personal interest, not the property that is being reimbursed. General rule: only non life insurance or property insurance contracts are contracts of indemnity. Life insurance contracts are not contracts of indemnity because the value of a life is immeasurable. Exception: where the basis of the insurable interest of the policy owner of the life of the insured is a commercial relationship, that is, creditor debtor, mortgager, or guarantor mortgagee. Then such contract of life insurance is an indemnity contract. For life insurance, nature of property, life insurance policies, unlike property insurance, are generally assignable or transferable as they are in the nature of property. Classes: 1. Marine insurance. Marine insurance is a type of transportation insurance which is concerned with the perils of property in or incidental to transit, as opposed to property perils at a generally fixed location. Marine insurance includes 1. Loss or damage to vessels, cargo, freightage, profit, and all kinds of property and interests therein, in connection with any all risks of perils of navigation. Persons or property appertaining to marine, inland marine, transit, or transportation insurance. Precious stones, jewels, jewelry, precious metals, whether in course of transportation or otherwise. Instrumentalities of transportation and communication, excluding buildings, aids to navigation and transportation, and appurtenant facilities for the control of waterways. Marine protection and indemnity insurance against liability incidental to ownership, operation, maintenance, or construction of vessels and facilities therefore. Division: marine insurance has two major divisions. Ocean marine insurance insures against risk connected with navigation to which a ship, cargo, freightage, profit, or other insurable interest in movable property may be exposed during a certain voyage or a fixed period of time. Its scope includes ships or hulls, goods or cargoes, earnings such as freight, passage money, commissions, or profits, and liability protection and indemnity insurance. Inland marine insurance covers the land or over the land transportation, perils of property shipped by railroads, motor trucks, airplanes, and other means of transportation. It also covers risks of lake, river, or other inland waterway transportation, and other waterborne perils outside those covered by ocean marine insurance. Loan on bottomry and respondentia distinguished. Loan on bottomry means loan that is obtained for the value of the vessels on a voyage. Loan on respondentia is a loan that is obtained as security for the value of the cargo to be transported. In a bottomry loan, the insurable interest of a ship owner on its bottomed boat is the difference between the amount of the loan and the value of the boat. Thus, if the amount of the loan does not cover the total value of the boat, the owner can still insure the boat. Boat loans depend upon the safe conclusion of the voyage. Risks. Two kinds of risks: perils of the sea, perils of the ship. Perils of the sea. Ocean marine insurance protects ships at sea and the cargo or freight on such ships from standard perils of the sea or perils of navigation. Includes losses caused by sea damage or by the violence of the elements, losses from extraordinary occurrences or those which cannot be guarded against by the ordinary exertion of human skill or prudence, barratry or the willful and intentional act on the part of the master or the crew in pursuance of some unlawful or fraudulent purpose without the consent of the owner and to the prejudice of his interests. Example, burning the ship, unlawfully selling the cargo. It excludes ordinary wear and tear of the voyage and from injuries suffered by the vessel in consequences of her not being unseaworthy. Perils of the ship. Perils of the ship are those which cause a loss, which in the ordinary course of events results from the ordinary natural and inevitable action of the sea, from ordinary wear and tear of the ship, and from the negligent failure of the ship's owner to provide the vessels with the proper equipment to convey the cargo under ordinary condition. In other words, we have perils of the sea versus perils of the ship. Perils of the sea covers those casualties due to unusual violence or extraordinary causes connected with navigation. It covers losses which cannot be guarded against by prudence and the ordinary exertion of human skill. Under perils of the ship, it covers losses resulting from the ordinary wear and tear or other damage incident to the voyage. It covers losses which result from the negligent failure of the ship's owner to provide the vessel with proper equipment and can thus be guarded against by ordinary exertion of human skill. Rule on all risks covered. General rule. In the absence of stipulation, the risks insured against are only perils of the sea and does not embrace all losses happening at sea. Exception. However, in all risks policy, all risks are covered unless expressly exempted. The burden rests on the insurer to prove that the loss is caused by a risk that is excluded. Loss. Loss may be total or partial. Total loss may be actual or constructive. So, total loss. Actual loss exists when the subject matter of the insurance is wholly destroyed or lost, or when it is so damaged that it no longer exists in its original character. It is caused by a total destruction of the thing insured, the irretrievable loss of the thing by sinking or by being broken up, any damage to the thing which renders it valueless to the owner for the purpose for which he held it, any other event which effectively deprives the owner of the possession at the port of destination of the thing insured, An actual loss may be presumed from the continued absence of a ship without being heard of. The length of time which is sufficient to raise this presumption depends on the circumstances of the case. Constructive total loss or technical total loss is one in which the loss, although not actually total, is of such character that the insured is entitled, if he thinks fit, to treat it as total by abandonment. A constructive total loss is one which gives to a person insured a right to abandon. Three rules exist as to when a constructive total loss exists. One English rule: there is constructive total loss when the subject matter of the insurance, while still existent in specie, is so damaged as not to be worth, when repaired, the cost of the repairs. American rule: there is constructive total loss when it is so damaged that the costs of repairs would exceed one half of the value of the thing as acquired, also known as 50% rule. In the Philippine rule, the insured may not abandon the thing insured unless the loss or damage is more than three-fourths of its value. A person insured by a contract of marine insurance may abandon the thing insured and recover for a total loss thereof when the cause of the loss is a peril insured against. If more than three-fourths thereof in value is actually lost or would have to be expended to recover it from the peril, if it is injured to such an extent as to reduce its value by more than three-fourths, if the thing insured is a ship, and the contemplated voyage cannot be lawfully performed without incurring either an expense to the insured of more than three-fourths of the value of the thing abandoned, or a risk which a prudent man would not take under the circumstances, or if the thing insured is cargo or freightage of the voyage cannot be performed, nor another ship procured by the master within a reasonable time and with reasonable diligence to forward the cargo without incurring either an expense to the insured of more than three-fourths the value of the thing abandoned, or a risk which a prudent man would not take under the circumstances. Note: freightage cannot in any case be abandoned unless the ship is also abandoned. Abandonment: it is the act of the insured by which, after a constructive total loss, he declares the relinquishment to the insurer of his interest in the thing insured. Conditions: aside from the requirements under Section 141 already mentioned above, an abandonment must be neither partial nor conditional, Section 142. An abandonment must be made within a reasonable time after receipt of reliable information of the loss, but where the information is of a doubtful character, the insured is entitled to a reasonable time to make inquiry. Abandonment is made by giving notice thereof to the insurer, which may be done orally or in writing, provided that if the notice be done orally, a written notice of such abandonment shall be submitted within 7 days from such oral notice. Abandonment must be absolute and total. No notice of abandonment is required for recovery of loss in case of actual total loss. Where the information upon which an abandonment has been made proves incorrect, or the thing insured was so far restored when the abandonment was made that there was in fact no total loss, the abandonment becomes ineffectual. Characteristics: a valid abandonment has the following characteristics. There must be an actual relinquishment by the person insured of his interest in the thing insured. There must be a constructive total loss. It must be factual. The notice of abandonment must be explicit and must specify the particular cause of the abandonment. Effects: an abandonment is equivalent to a transfer by the insured of his interest to the insurer, with all the chances of recovery and indemnity. If a marine insurer pays for a loss as if it were an actual total loss, he is entitled to whatever may remain of the thing insured, or its proceeds or salvage, as if there had been a formal abandonment. Upon an abandonment, acts done in good faith by those who were agents of the insured in respect to the thing insured subsequent to the loss are at the risk of the insurer and for his benefit. Average. An average is the ordinary or accidental expense incurred during the voyage for the preservation of the vessels or the vessel, cargo, or both, and all the damages to the vessel and cargo from the time it is loaded and the voyage commenced until it ends and the cargo is unloaded. There are two kinds of averages: gross or general averages and simple or particular averages. Let's differentiate. Gross or general average. It includes damages and expenses which are deliberately caused by the master of the vessel or upon his authority in order to save the vessel, her cargo, or both at the same time from a real and known risks. The loss is borne by all the owners of the interest involved who are pro tanto obliged to give proportionate contributions to make up for such loss, since the sacrifice was made for the common benefit of all who have an interest in the venture. Simple or particular average, on the other hand, includes damages and expenses caused to the vessel or her cargo which have not inured to the common benefit and profit of all the persons interested in the vessel and her cargo. The loss is suffered by and borne alone by the owner of the cargo or of the vessel, as the case must be. Such loss is not suffered by all persons contributing ratably. To claim general average contributions, the requisites are: 1. There must be a common danger to the vessel or cargo. The sacrifice must be for the common safety or for the benefit of all. It must be successful, that is, resulted in the saving of the vessel and or cargo. Expenses or damages should have been incurred or inflicted after taking proper legal steps and authority. Some inclusion: sacrifice was made by the master upon his authority and that it was not caused by any fault of the party asking for the contribution. An example of particular average loss would be the wages of the crew when the vessel is detained by reason of force majeure. In such a case, the loss is only partial and must be borne by the owner of the vessel alone. Rule on averages in marine insurance, where it has been agreed that an insurance upon a particular thing or class of things shall be free from particular average. A marine insurer is not liable for any particular average loss, not depriving the insured of the possession of the whole of such thing or class of things at the port of destination, even though it becomes entirely worthless. However, such insurer is liable for his proportion of all general average loss assessed upon the thing insured. Warranties. Marine insurance is unique in that it has certain implied warranties. Implied warranty of seaworthiness, of against improper deviation, and of proper documentation. Implied warranty of seaworthiness. In every marine insurance upon a ship or freight or freightage or upon anything which is the subject of marine insurance, a warranty is implied that the ship is seaworthy. A vessel is seaworthy if it is fit to perform the service and to encounter the ordinary perils of the voyage contemplated by the parties to the policy. It is properly laden. It is provided with a competent master. It is provided with a sufficient number of competent officers and seamen. It is provided with the requisites, appurtenances, and equipment. It is provided with other necessary or proper stores and implements for voyage. A vessel should be seaworthy at the time commencement of the risk or start of the voyage, except when the insurance is made for a specified length of time. The implied warranty is not complied with unless the ship be seaworthy at the commencement of every voyage it undertakes during that time. When the insurance is upon the cargo, which by the terms of the policy, description of the voyage, or established custom of the trade, is to be transshipped at an intermediate port, the implied warranty is not complied with unless each vessel upon which the cargo is shipped or transshipped be seaworthy at the commencement of each particular voyage. Where different portions of the voyage contemplated by a policy differ in respect to the things requisite to make the ship seaworthy, therefore, a warranty of seaworthiness is complied with if the commencement of each portion the ship is seaworthy with reference to that portion. The insurer is not liable despite breach of warranty when the ship becomes unseaworthy during the voyage to which an insurance relates, but there is an unreasonable delay in repairing the defect. Implied warranty against improper deviation is a departure from the course of the voyage insured, or an unreasonable delay in pursuing the voyage, or the commencement of an entirely different voyage. Deviation is proper when, like insurer remains liable, when caused by circumstances over which neither the master nor the owner of the ship has any control, when necessary to comply with a warranty or to avoid a peril, whether or not the peril is insured against, when made in good faith and upon reasonable grounds of belief in its necessity to avoid a peril, or when made in good faith for the purpose of saving human life or relieving another vessel in distress. Every deviation not specified in the last section is improper. Section 127. Effect of any loss subsequent to any improper deviation, insurer is not liable. Implied warranty of proper documentation where the nationality or neutrality of a ship or cargo is expressed warranted. It is implied that the ship will carry the requisite documents to show such nationality or neutrality, and that it will not carry any documents which cause reasonable suspicion thereon. Life insurance is insurance on human lives and insurance appertaining thereto or connected therewith. The following shall be considered a life insurance contract for purposes of the insurance code. Every contract or undertaking for the payment of annuities, including contracts for the payment of lump sums under a retirement program where a life insurance company manages or acts as a trustee for such a retirement program. Every contract or pledge for the payment of endowments or annuities. An insurance upon life may be made payable on the death of the person or on his surviving or specified period or on the continuance or cessation of life. Parties, owner of the policy, cestui que v. beneficiary, with the power to name the beneficiary, assign it, cash it in, or use as collateral with the obligation to pay the premiums. That is the owner of the policy. Insured is the one on whose life insurance is obtained, or cestui que v. Beneficiary, one to whom the proceeds may be paid. There are also cases wherein there may be one person only for all three parties. Like there are 4 types of life insurance. We have the individual life, group life, industrial life, and micro insurance. Individual life is an insurance on human lives and insurance appertaining thereto or connected therewith. It may be made payable on the death of the person or after his surviving or specified period, or an annuity or endowment, or otherwise contingently on the continuation or cessation of life. For group life insurance, it is a blanket policy covering a number of individuals who are usually a cohesive group, like employees of a company and subject to a common risk. No medical examination is usually required of each person insured. Group insurance is a single insurance contract that provides coverage for many individuals. The employer policyholder is the agent of the insurer in collecting the premium. Typically, the policy owner is an employer and the policy covers the employees or members of the group, with one master contract kept by the employer, where the employee is required to pay a portion of the premium. The arrangement is called a contributory plan, wherein his share is deducted from his wages. Industrial life insurance refers to an insurance policy under which the premiums are payable either monthly or oftener. If the face amount of insurance provided in any policy is not more than 500 times that of the current statutory minimum daily wage in the city of Manila, and the words industrial policy are printed upon the policy as part of the descriptive matter. It provides insurance coverage to industrial workers or people who are unable to afford insurance for bigger amounts. It shall not lapse after non-payment of premiums in 3 months after the expiration of the grace period if such non-payment is due to the failure of the company to send its representative to the insured to collect premiums. Other classifications of life insurance policies. We have the ordinary or whole life policy where the insurer agrees to pay the face value of the policy upon the death of the insured. Distinct variations of whole life policy. Ordinary life insurance premiums are paid throughout the lifetime of the person. Limited payment life insurance premiums are paid only during a specified number of years or until a specified event occurs. Single premium life insurance, the coverage is acquired by the payment of a single premium. Joint life insurance, coverage is payable upon the first death among two or more insured. Universal life insurance emphasizes the separation of the portion of the premium that is used to cover the insurance protection from the portion of the premium allocated to an investment. Variable life insurance, some amount of death benefit provided by a variable life insurance policy is guaranteed by the insurer. Pure endowment policy, where the insurer pays the insured if the insured survives as a specified period. If the insured dies within the period, the insurer releases from liability. Compulsory motor vehicle liability insurance. This is an insurance policy or a guarantee in cash or surety bond to indemnify the death, bodily injury, and or damage to property of a third-party passenger arising from the use of a motor vehicle. It shall be unlawful for any land transportation operator or owner of a motor vehicle to operate the same in the public highways unless there is in force or policy of insurance or guarantee in cash or surety bond, issued in accordance with the provisions of this chapter to indemnify the death, bodily injury, or damage to property of a third party or passenger, as the case may be, arising from the use thereof. It is a requisite for registration or renewal of registration of a motor vehicle by every land transportation operator or owner. It is the only type of compulsory insurance provided for under the Insurance Code. It applies to all vehicles, whether public or private vehicles. To the extent that motor vehicle insurance is compulsory, it must be a liability policy, and the provision making it merely an indemnity insurance contract cannot have any effect. The insurer's liability is direct and primary, so the insurer need not wait for final judgment in the criminal case to be liable. The purpose is to give immediate financial assistance to victims of motor vehicle accidents and or their dependents, regardless of the financial capability of motor vehicle owners or operators responsible for the accident sustained. The claimants or victims may be a passenger or a third party. The insured may be the party at fault as against claims of third parties. Clauses that are relevant to the compulsory motor vehicle liability insurance. One authorized driver clause is a stipulation in a motor vehicle insurance policy which provides that the driver, other than the insured owner, must be duly licensed to drive the motor vehicle. Otherwise, the insurer is excused from liability. Theft clause is a stipulation including theft as one of the risks insured against. If there is such a provision and the vehicle was unlawfully taken, the insurer is liable under the theft clause and the authorized driver clause does not apply. The insured can recover even if the thief has no driver's license. No fault clause is a provision required in every compulsory motor vehicle liability insurance regarding claims for death or injury to a passenger or a third party on a liability insurance policy covering the vehicle. Any claim for death or injury to any passenger or third party shall be paid without the necessity of proving fault or negligence of any kind, provided the total indemnity in respect of any person shall not exceed 15,000. The claim shall be made against only one motor vehicle. It shall lie against the insurer of the vehicle in which the occupant is riding and no other. The claimant is not free to choose from which insurer he will claim the no-fault indemnity. Compulsory insurance covered by agency hired workers. Compulsory insurance covered or coverage for agency hired workers is an insurance mechanism made available by the law to provide insurance protection for OFWs. Each migrant worker to be deployed by a recruitment or manning agency shall be covered by a compulsory insurance contract which shall be secured at no cost to the said worker. Basis, it is the policy of the state to provide adequate protection to the overseas Filipino workers by ensuring coverage under the compulsory insurance requirement in Section 37A of the Migrant Worker and Overseas Filipino Act of 1995 as amended. Qualifications to be qualified to provide for the migrant workers' compulsory insurance coverage. The insurance company must be a reputable private life, non-life, and composite insurance company, be duly licensed by IC, be in existence and operational for at least 5 years, have a net worth of at least 500 million based on the audited financial statement for the immediately preceding year, have a current year certificate of authority, and have an IC approved standard policy. Disqualifications: insurance companies who have directors, partners, officers, employees, or agents with relatives within the fourth civil degree of consanguinity or affinity who work or have interest in any of the licensed recruitment or manning agency or in any of the government agencies involved in the overseas employment program shall be disqualified from providing the migrant workers insurance coverage. It shall be the duty of the said directors, partners, officers, employees, or agents to disclose any such interest to the IC and POEA. Variable contracts. Variable contracts refers to any policy or contract on either a group or on an individual basis issued by an insurance company providing benefits or other contractual payments or values thereunder to vary so as to reflect investment results of any segregated portfolio of investment or a designated separate account in which amounts received in connection with such contracts shall have been placed and accounted for separately and apart from other investments and accounts, and or benefits or values incidental thereto, payable in fixed or variable amounts, or both. It shall not be deemed to be a security or securities as defined in the Securities Act as amended, or in the Investment Company Act as amended. No insurance company authorized to transact business in the Philippines shall issue, deliver, sell, or use any variable contract in the Philippines unless and until such company shall have satisfied the commission that, or the commissioner that, its financial and general condition and its methods of operation, including the issue and sale of variable contracts, are not and will not be hazardous to the public or to its policy and contract owner. No foreign insurance company shall be authorized to issue, deliver, or sell any variable contract in the Philippines unless it is likewise authorized to do so by the laws of its domicile. In determining the qualifications of a company requesting authority to issue, the commissioner shall always consider the following: the history or financial and general condition of the company, provided that such company, if a foreign company, must have deposited with the commissioner for the benefit and security of his variable contract owners in the Philippines securities satisfactory to the commissioner, consisting of bonds of the government of the Philippines or its instrumentalities with an actual market value of 2 million pesos. The character, responsibility, and fitness of the officers and directors of the company, and the law and regulation under which the company is authorized in the state of domicile to issue such contracts. If after notice and hearing the commissioner shall find that the company is qualified to issue, deliver, sell, or use variable contracts in accordance with this code and the regulations and rules issued thereunder, the corresponding order of authorization shall be issued. Any decision or order denying authority to issue, deliver, sell, or use variable contracts shall clearly and distinctly state the reasons and grounds of which it is based. Any insurance company issuing variable contracts pursuant to this code may, in its discretion, issue contracts providing a combination of fixed amount and variable amount of benefits, and for option lump sum payment of benefits. Insurable interest: that interest which a person is deemed to have in the subject matter insured, where he has a relation or connection with or concern in it, such that the person will derive pecuniary benefit or advantage from the preservation of the subject matter insured and suffer pecuniary loss or damage from its destruction, termination, or injury by the happening of the event insured against. An insurable interest is one of the most basic and essential requirements in an insurance contract. The existence of an insurable interest gives a person the legal right to insure the subject matter of the policy of insurance. It may not be waived by stipulation. Absence of insurable interest renders the insurance policy void. General rule: insurable interest must be capable of pecuniary estimation because the purpose of insurance is to indemnify. It would be difficult to measure if the benefit derived or the loss incurred is not capable of pecuniary estimation. Exception: the insurable interest need not always be pecuniary in nature. Example: in insuring the life of person, the purpose is not to indemnify but to act as an investment or savings instrument. Rationale: as a deterrence to the insured, a policy issued to a person without insurable interest is a mere wager policy or contract and is void for illegality. Evidence that life insurance is regarded as a wager policy: the original proposal to take out insurance was that of the beneficiary. The premiums are paid by the beneficiary. The beneficiary has no interest, economic or emotional, in the continued life of the insured. As a measure of limit of recovery, the insurable interest is the measure of the upper limit of his probable loss under the contract. Insurance should not provide the insured means of making a net profit from the happening of the event insured against. And for life insurance, insurable interest over life health must exist at the time of the inception of the contract but may be lost after. For property insurance, insurable interest must exist at the time of the inception of the contract and at the occurrence of the loss, but it need not exist during the intervening period or from the time between when the policy takes effect or the loss occurs. The alienation of insured property will not defeat a recovery if the insured has subsequently reacquired the property and possesses an insurable interest at the time of loss. Change of interest. Change of interest means the absolute transfer of the property insured. General rule: a change of interest in the thing insured does not transfer the policy, but suspends the insurance to an equivalent extent until the interest in the thing and the interest in the insurance policy are vested in the same person. Thus, the contract is not rendered void but is merely suspended. Exception: life, health, and accident insurance. A change of interest in the thing insured after the occurrence of an injury which result in a loss does not affect the policy. A change in the interest in one or more of several things separately insured by one policy, such as a conveyance of one or more things, does not affect the policy with respect to the others not so conveyed. A change of interest by will or succession on the death of the insured, his interest passes to his heir or legal representative who may continue the insurance policy on the property by continuing paying premiums. A transfer of interest by one of several partners, joint owners, or owners in common who are jointly insured to the others. This will avoid the policy only as to the selling partners or to owners but not as to others. Automatic transfer of interest in cases in which the policy is so framed that it will inure to the benefit of whosoever may become the owner of the interest insured during the circumstances of the risk. It is an exception to the general rule that upon maturity, the proceeds of a policy shall be given exclusively to the proper interest if the person in whose name or for whose benefit it is made. In case of an express prohibition against alienation in the policy, alienation will not merely suspend the contract but avoid it entirely. In life or health, every person has an insurable interest in the life and health of himself or of his spouse and of his children, of any person on whom he depends wholly or in part for education or support, or in whom he has a pecuniary interest, of any person under a legal obligation to him for the payment of money or respecting property or services, of which death or illness might delay or prevent the performance, and of any person upon whose life and estate of interest vested in him depends. A person is not allowed to take out insurance upon the life of a stranger. There is no insurable interest in the life of an illegitimate spouse. A creditor may take out insurance on the life of his debtor, but his insurable interest is only up to the amount of the debt, and only when the debt is unsecured. General rule: the measure of indemnity under a policy of insurance upon life or health is the sum fixed in the policy. Exception: unless the interest of a person insured is susceptible of exact pecuniary measurement. In life insurance, types of life insurance, you have interest in one's life, in one's own life, and interest in life of another, beneficiary of life insurance. Now, in health insurance, the general rule is interest in the life or health of a person must exist at the inception of the insurance contract but need not exist thereafter or even the loss occurs. Exception: in the case of a creditor's insurance taken on the life of the debtor, insurable interest disappears once the debt has been paid. In the case of a company's insurance taken on the life of an employee, insurable interest disappears once the employee leaves the company. In property, the following are considered as insurable interests provided that they are of such nature that a contemplated peril might directly indemnify the insured. Every interest in real or personal property, that is, ownership, and a relation thereto, like interest of a trustee or a commission agent, any liability in respect thereof, like interest of a carrier or depository of goods. A person has an insurable interest in property when he sustains such relation with respect to it that he has a reasonable expectation of benefit to be derived from its continued existence, or loss or liability from its destruction. An insurable interest in property may consist in an existing interest. Existing interest in property may be on a legal title or equitable title. Example of those having existing interests are owners or regards their properties, trustees in the case of the seller, and mortgagors over the property mortgage, and lessee, and sublessee over the property lease. An inchoate interest founded on an existing interest. Inchoate interest in property exists, but as incomplete or unripe until the happening of an event. Examples of inchoate interests are the interests of stockholders with respect to dividends in case of profits and